Let me begin with a warning disguised as a question. When the largest asset manager in the world makes a quiet but consequential trade, should we really believe it is just another routine market adjustment? History tells us otherwise. In 1987, markets collapsed not because of ignorance, but because of confidence in models, in institutions, and in the belief that risk had been mastered. Today, as January 2025 approaches, we are once again being asked to trust that the system is stable, even as its largest players behave as if it is not. BlackRock does not trade like ordinary investors. It does not react, it anticipates. When it shifts capital, it is not guessing, it is repositioning. The significance of a BlackRock trade lies less in its size and more in its direction. It reflects what those closest to the machinery of global finance see coming. And here is the first hook we must confront. When the architects of the system quietly hedge, while the public is encouraged to stay invested, something is deeply wrong. To understand why this moment echoes 1987, we must revisit what caused that crash. It was not panic alone. It was automation, leverage, and blind faith in financial innovation. Portfolio insurance, sold as a risk-reducing strategy, became a risk-amplifying machine once markets turned. Today, we see a similar structure: algorithmic trading, passive investing, and massive concentration of assets under firms like BlackRock. Different tools, same illusion. That complexity equals safety? Here is the second hook: risk has not disappeared, it has been centralized. When trillions of dollars move through the same strategies, the same indexes, and the same automated responses, markets become fragile, not resilient. A small shock can trigger synchronized selling, just as it did in 1987. The difference now is scale. The interconnectedness is deeper, faster, and global. What once unfolded over days can now unfold in minutes. BlackRock's trade signals awareness of this fragility. It suggests preparation for volatility, liquidity stress, or a repricing of assets that have floated far above the real economy. And let us be clear, this is not about one firm acting maliciously. This is about rational behavior within an irrational system. Institutions protect themselves first. That is what they are designed to do. The myth is that they will protect everyone else along the way. The third hook cuts even deeper. While institutional capital adjusts quietly, ordinary investors are told to remain calm, to stay the course, to trust long-term fundamentals. This asymmetry of information is not accidental, it is structural. Those with access to power exit first, those without it absorb the shock. In 1987, pensions and retirement accounts paid the price. There is little reason to believe 2025 would be different. What makes this moment especially dangerous is the political and economic backdrop. High interest rates, record corporate debt, geopolitical tensions, and slowing global growth form a combustible mix. Financial markets are priced for optimism, while material conditions suggest constraint. When expectations and reality diverge this sharply, corrections are not gentle, they are violent. When an institution like BlackRock makes a significant trade, it is a mistake to interpret it as routine portfolio management. BlackRock does not operate at the margins of the financial system, it operates at its core. With trillions of dollars under management, its decisions are informed by privileged access to data, policymakers, and corporate balance sheets that are invisible to ordinary investors. This is the first hook that must be grasped. BlackRock does not react to markets in the way the public does. It anticipates structural shifts before they become visible. Such trades function as signals because they reflect internal assessments of risk that go far beyond quarterly earnings or short-term volatility. When BlackRock reallocates capital, it is responding to stress points it perceives in liquidity, leverage, or market plumbing. These are not speculative instincts. They are risk management responses shaped by the understanding that when markets turn, size becomes vulnerability. The larger the institution, the more difficult it is to exit without disrupting the system itself. Here is the second hook. What is framed as prudence at the institutional level often precedes turbulence at the market level. Large asset managers hedge not because catastrophe is guaranteed, but because the cost of being unprepared is unacceptable. These hedges frequently involve moving into cash, like instruments, volatility protection, or defensive assets. To the public, these moves appear boring or technical. In reality, they are quiet acknowledgments that the probability distribution of outcomes has shifted toward instability. There is also a deeper informational imbalance at work. Institutional trades are executed gradually, discreetly, and with narrative cover. Public communication remains optimistic even as positioning becomes defensive. This separation between message and behavior is not hypocrisy, it is structure. Financial systems reward calm messaging while privately preparing for disorder. The public sees confidence, the balance sheets reveal caution. This is where the historical parallel becomes unavoidable. In periods preceding major dislocations, from 1987 to 2008, large institutions adjusted exposure early, while smaller participants remained exposed. The lesson is uncomfortable but consistent. Systemic signals are embedded in institutional behavior, not in headlines. BlackRock's trade, therefore, is not important because it predicts a crash on a specific date, but because it reveals how those closest to systemic risk are choosing to protect themselves. The final hook cuts to the heart of modern finance. If the most powerful actors behave as though the system is fragile, while the rest are encouraged to believe it is stable, then fragility is no longer a possibility, it is a condition. In such an environment, institutional trades are not just investments, they are warnings written in capital rather than words. The modern financial system is often praised for its efficiency, liquidity, and sophistication. Yet beneath that surface lies a structural weakness that is rarely acknowledged. Risk has not been reduced. It has been concentrated. Trillions of dollars now move through a small number of asset managers, passive funds, and algorithm-driven strategies. This concentration creates an illusion of stability while quietly building the conditions for systemic fragility. The first hook is this: when everyone owns the same assets in the same way, diversity disappears, and with it, resilience. Passive investing and index replication are central to this problem. These strategies do not assess value or fundamentals, they allocate capital based on size and inclusion. When markets rise, money flows automatically into the largest firms, pushing prices higher regardless of underlying economic performance. This feedback loop creates market momentum that appears healthy, but is increasingly detached from reality. The danger emerges not during calm periods, but when conditions change and these same mechanisms reverse direction. Here is the second hook that demands attention. Automation accelerates fear. Algorithmic systems are designed to respond instantly to price movements, volatility thresholds, or liquidity signals. They do not pause to interpret context or assess long-term consequences. When selling begins, these systems often reinforce one another, transforming a modest decline into a cascading event. What once unfolded over hours or days can now occur in seconds, leaving little room for human intervention. Centralization magnifies this effect. When a small number of firms manage enormous pools of capital, their actions become market-moving by definition. A defensive shift by one large institution forces others to respond, not out of panic, but out of necessity. Liquidity evaporates precisely when it is needed most, because everyone is trying to exit the same doors at the same time. This is not market failure in the traditional sense, it is systemic design revealing its limits. There is also a political and psychological hook embedded in this structure. The narrative presented to the public emphasizes safety, diversification, and long-term stability. Meanwhile, the architecture of the system ensures that shocks are transmitted rapidly and broadly. Confidence becomes performative, masking a reality in which markets are increasingly brittle. This concentration of risk challenges the foundational assumption of modern finance, that spreading ownership reduces danger. In practice, spreading ownership through identical strategies produces synchronization, not safety. The system becomes highly efficient at amplifying trends and dangerously inefficient at absorbing shocks. What appears as order is, in fact, tightly coiled instability, waiting for a trigger small enough to be dismissed and powerful enough to unravel the whole structure. The comparison to 1987 is often dismissed as alarmist, yet a closer examination reveals unsettling structural similarities beneath the surface differences. In 1987, markets were not undone by ignorance or irrational panic. They were destabilized by confidence in systems designed to manage risk automatically. Portfolio insurance was promoted as a sophisticated safeguard, but when prices began to fall, it required selling into weakness, accelerating the very collapse it was meant to prevent. The first hook is clear. The danger did not come from fear, but from faith in financial engineering. Today's market architecture carries that same DNA, only at a far greater scale. Algorithmic trading, volatility targeting funds, risk parity strategies, and passive index flows all promise efficiency and risk control. Individually, each appears rational. Collectively, they behave like a single organism. When conditions shift, they respond in unison. This synchronization is the modern equivalent of portfolio insurance. embedding pro-cyclical behavior into the system itself. Here is the second hook that should not be ignored: speed has replaced judgment. In 1987, selling cascaded over hours as programs triggered sequentially. Today, similar mechanisms operate at machine speed, reacting to price movements before human decision makers can even interpret what is happening. Liquidity, which appears abundant in calm markets, vanishes in moments of stress. What looks like a deep market is often shallow, dependent on continuous confidence rather than durable buyers. The parallels extend beyond technology to mindset. In both periods, financial innovation was celebrated as progress that had supposedly tamed volatility. Risk models were trusted because they were mathematical, precise, and back-tested. Yet models are built on assumptions about normal conditions. When those assumptions break, the models do not fail gracefully, they fail catastrophically. The belief that this time is different was as prevalent then as it is now. Another hook lies in leverage. While leverage in 1987 was visible and direct, today it is embedded in derivatives, structured products, and balance sheet complexity. It is harder to see, but no less powerful. Small price movements can still force large reallocations, margin calls, and forced selling. The mechanics differ, but the vulnerability remains. These similarities matter because they reveal a recurring pattern in financial history. Crashes are not random. They are the outcome of systems that amplify stress rather than absorb it. The echo of 1987 is not about repeating the same numbers or dates, but about repeating the same mistake, confusing technical sophistication with systemic safety, and mistaking engineered confidence for genuine stability. Modern financial markets operate on an unequal distribution of information and power, and this imbalance becomes most visible during moments of stress. Institutional investors do not simply have more money, they have earlier access to data, direct communication with policymakers, and the ability to interpret market signals long before they reach the public. This is the first hook that must be understood. Markets are not shared experiences. They are layered, and those at the top feel the tremors before anyone else does. When large institutions begin adjusting positions, they do so quietly and gradually. Trades are broken into pieces, spread across time, and executed through complex channels that avoid drawing attention. Public messaging, however, remains reassuring. Investors are told that volatility is temporary, that fundamentals are strong, and that patience will be rewarded. This separation between action and narrative is not accidental, it is structural. Stability must be projected even as risk is privately reduced. Here is the second hook. The advice to stay the course is not neutral. It assumes equal capacity to absorb losses, which does not exist. Institutional investors can withstand drawdowns, hedge exposure, and access liquidity under favorable terms. Retail investors, pension holders, and workers tied to retirement accounts cannot. When markets fall sharply, they bear losses in real time, often forced to sell at the worst possible moment due to life needs rather than strategy. This asymmetry was painfully clear in past crises. In 1987, pension funds absorbed losses while institutions had already repositioned. In 2008, complex financial products collapsed after insiders had exited. The pattern repeats because the structure has not changed. Information flows upward, risk flows downward. The public enters markets through simplified narratives, while institutions navigate them through detailed maps unavailable to others. There is also a psychological hook embedded in this imbalance. Confidence is managed. When powerful actors express calm, it reassures markets even as their own balance sheets tell a different story. By the time fear becomes visible to everyone, it is already too late to act rationally. Panic is not the cause of losses, it is the result of delayed awareness. This dynamic exposes a core contradiction in modern capitalism. Markets are presented as democratic spaces, yet outcomes are shaped by unequal access and unequal timing. When institutions quietly step aside, while others are encouraged to remain exposed, volatility becomes a mechanism of redistribution rather than risk. Losses are not shared evenly, they are allocated along lines of power, reminding us that financial crises are never just economic events, but reflections of who knows first and who pays last. So when we hear about a BlackRock trade, we should not treat it as financial gossip or insider trivia. We should treat it as a signal, one flashing from the heart of global capitalism. The lesson of 1987 was not simply that markets crash, but that they do so when confidence outruns reality. As January 2025 approaches, the real question is not whether a crash will look exactly like 1987. The real question is whether we have learned anything at all. Because if we haven't, History will not repeat itself politely, it will repeat itself brutally.